Good morning, everybody. Thank you guys so much for joining. Good morning, John Walkup.
Hey, Noah, good morning to you.
It is a
In
macro.
June, first macro Monday of June.
Hey, we got a new month. We got new charts, Johnny. New charts. New charts are in. We'll get to that at the end of the show today.
These are the things we look forward to.
Hey, man, we need the latest information. The people need to know what's going on. And that's what we're going to do here, guys. Thank you so much for joining. It is Monday, so we're going to give you a little macro Monday coming right at you guys. That is John Walkup. I am Noah Rosenblatt. We're both with UrbanDigs. For those of you that are new to the show, we're going to start out with Manhattan real estate, take a quick peek on the monthly trends, and then we're going to go to a bunch of macro topics up here, guys. We're going to go over the standards, the credit spreads. We're going to go over the Fed fund futures, what the markets think is happening with interest rates. We'll show you a couple of charts that might be meaningful. Maybe they won't be, maybe they will. And then we will circle back to Manhattan real estate and try to end on a couple of charts now that the new month is in and we got fresh data. And we'll try to do this in 30 minutes or less. Okay. Johnny, anything I missed other than the house call? Don't start day trading this stuff. No financial advice?
Not financial advice, 30 minutes or less, or it's free. I think you covered it all. I mean,
I think it is free.
Noah's just itching to get out and enjoy the weather. So we're trying to get things going along.
I am. It is. It's supposed to be gorgeous out there. But let's just get right to it, guys. We're on a delay. We're on a 20-second delay. We're going to try to keep everything timely, but you guys, please ask your questions as you go. There should be a live comments thing over there. Johnny's going to do his best to keep an eye on it. Let's get started, guys. I want to start with the market snapshot. This is on your dashboard of UrbanDigs. I am looking at the ticker. I clicked on 1 month. Let's first look at supply. We're at 1561 over the last 30 days. May printed high. I believe it was like 200 plus high. I think we're supposed to have like 1540 and we came in at 1760 or something. So a lot more supply came on in May than typical, John.
Right. Yeah, no, and that's the thing. So if you guys watch our weekly updates, we've been talking about supply. And for the longest time, the story with supply was, well, there's no story. But I think over time, that sort of story of supply, that there is no story, has turned into a story, which is that it's been doing what it always does. And because of that, it's just started to add up. And so over time, it's just kind of building slowly but surely, especially in Brooklyn.
Yeah. And it's interesting, again, during the time of uncertainty, that supply kept coming on. Usually when that happens, supply kind of cools off and sellers are like, I'll wait this one out. But no, we had more listings come on. So that's a trend that you guys should keep an eye on. 1561 is our current print for 30 days. Right? I could go right here. I could see that's May 3rd to yesterday. Okay, June 1st. We're supposed to end June at 1386. Okay, so this should trend down. So we're now at the end of the listing season for spring. You might have a couple of weeks in June, maybe, but the second half of June is going to probably see declining inventory. So buyers out there, you're probably getting close to peak supply for the season right now. Got to let them know what's going on.
Yeah, okay? I think that's fair to say.
Yeah. Contract signed, deal activity. We're at 934 right now. Mondays are always, the trickiest because it's following the weekends. It's always low on Mondays. 934. That's supposed to end the month at 1,055. Okay. May just printed and we had lower contract activity. I think we had like 1,050-ish in May and we were supposed to be at 1,120 or so. So the skinny of it is that for May, you had more supply coming on than is seasonally average, and you had less contract activity that is seasonally average. And if you look at the market pulse, okay, look at the market pulse, that is why during the course of May, we continue to drop down, and it looks like we're just building a little house here at this new level, John.
Well, I like the double analogy, the real estate market pulse building a house. I guess I would just ask you what kind of, what do you mean by house there?
Well, it looks like we're camping out here.
I see what you're saying.
We're at a lower level than where we were in April. And we're just, I don't know if we're bouncing from this level, but we're not falling anymore. We're just found a new level to hang out at.
Well, I think you hit the nail on the head there, Noah. And I think the whole point is that we're really finally starting to show the April volatility mess that impacted the markets. And for a while, we were waiting to understand what that might look like in the data, because as you know, once a buyer sees a place, they kick the tires to get the contract and negotiations rolling. It takes a couple of weeks to kind of play through those out. And then you kind of have to wait to kind of get a sense for what that new stuff is. Now we have a sense, and that pulse certainly did drop pretty sharply from April into May. And you're right. Now we've kind of like reset. We're kind of like, all right, well, what now?
Exactly. And that's what's going on right here. I don't see any other data points that's going to tell me any color of which way we're going from this point, but we're just at a different level than where we were a month and a half ago, to the negative side. So it's a little bit more of a leverage shifting away from sellers towards buy side situation over the last month and a half. What you guys felt is probably what's going on here, the sales market. If you joined us for Phil Horrigan's session last week, we had a great experts. It's such a great thing, that Phil Horrigan session. He does it every like 3 months. It's not that often. But he asks the agents to rank the sales and rental market, and everyone came in at like a 5. Sales, but it's like a 5. Feels like so it's nothing bigger than that. So that's that. Okay.
Yeah.
We'll touch base on the rental market towards the end of the show. Okay. Okay. Any questions, John?
Do I have questions? No, I don't see any either in the chat. No. But again, I mean, I think the whole point about that 5 for the market means it's less market driven and more product driven, product and price, right? It's very, very idiosyncratic. It's what you have to sell, when you have to sell it, how you're pricing it. That's really what's going to drive the market for each of those things. Everything kind of like breaks up into its own little fiefdoms. It's not like you have one market that's pushing everything higher and getting the buyers out. It's very, very idiosyncratic. It's tough.
It's a tricky market. And we'll touch base on some of the new charts and give you as much color as we can. You're right, and I still think the market's penalizing those estate condition unrenovated apartments. It felt like there was a comeback coming earlier in the year, but I don't know. I feel like it's faded a little bit. We'll talk about that towards the end. Let's shift to macro part of the program, guys. We're going to look at credit spreads. Okay, guys, credit spreads. I'm going to hit max on this chart and show you credit spreads right here, so you guys can see what direction means bad and what direction means good. The great financial crisis is a great proxy. So credit spreads basically are the spread between corporate bonds. Okay, and there's different kind of corporate bonds. There's investment grade, there's high yield, corporate bonds, and safe U.S. Treasuries. Okay, safe U.S. Treasuries. And either that spread is narrowing, which would be a good sign, and that means this index is going down. That means there's less credit stress in the system. It's getting better, or it's widening. And if those credit spreads are widening, that means there's more credit stress in the system, and that typically brings on a risk-off environment. And a risk-off environment is basically stocks going down and buyers of real estate just taking a pause and all that kind of stuff. So it does trickle down to psychology, buy-side psychology, and our markets. Ultimately, it's up here and it trickles down. So you see the full chart, so you know that when this goes up it's bad and when it goes down it's good. So let's take a look at the last 6 months, guys, and you can pretty much see what we're talking about here with that whole March, April, May thing, right? This is the old tariff uncertainty. It looks like peak uncertainty was the first week of April.
Yeah.
And it's just been narrowing. It's just been coming down since. We're just above the level before we started, but I mean, stocks at record highs, John. I don't know.
Yeah, I know. I think that for me though, and I think I mentioned this, I mean, we didn't have Macro Monday last week because of Memorial Day, but like 2 weeks ago, I think my point was that to me, the bias is still to the upside in terms of this indicator, the idea that if they're going to break one way or the other, given the fact that there's more uncertainty than less, I would expect this to kind of tick higher. But I mean, look, I can't argue the fact that really since early April, since it did make that peak, it really has been on a downtrend. But I guess the point is, it seems like we're stalling out here, and we're stalling out at a slightly higher level than we were for like the 6 months or so before that. So, you know, going forward, I don't know which way it's going to go. I still think it's likely to go higher. Just, you know, if all things are equal, there's more uncertainty out there in terms of what that headline risk is. But it almost seems like and I think this goes for the real estate market too. And we'll kind of get into this stuff a little bit later, but I almost get the feeling like we're in this reset mode. Like, all right, let's put this crazy month and a half behind us and start fresh and see what happens. But again, that's, you know, back to ground zero here.
I like to read credit spreads as just like either there's a rising problem or there's not, kind of a thing. To me, I don't see any stress here anymore. I mean, I did, right? I did when this was up here, and on the way down, we weren't sure if we believed it or not. But like, you're right. We're at a higher level than we were before, and we are in a moderately elevated credit stress environment. That's what this little stage is up here. But we're going the right direction, and credit stress is easing, and stocks are near all-time highs. So I don't know if the markets are thinking that there's any kind of credit event like a Lehman Brothers or anything out there. Certainly not even close to that level from the great financial crisis. It's just, it looks okay to me right here. And if, as long as this is going down, even if we stay here, even if we just flatline and stay here, that to me could be like a risk on or just a sideways market. We're not going down though. You know,
no, I true, but I think the more salient point on my end is that the fact that they're up means the price of money, and I'm just, aside from interest rates, that risk premium that banks are going to charge firms and mortgage banks are going to charge buyers is going to be a little bit more. Like, so you're getting a little bit more risk there in the markets, and I think that's going to kind of keep that cost of capital up rather than low.
Okay, well, we'll get into that because the next thing on the agenda is going to be rates. Guys, we're going to shift and pivot to the rates portion of the program. Okay, and for that, we're going to the FedWatch tool at CME Group. Guys, you could do this yourself. You could go here at creditspreadalert.com, by the way, and look at credit spreads. This updates at 10:30 every day. For rates, we're going to go to the CME Group FedWatch, and we're going to scroll down and click on that probabilities table, guys. What you're looking at here is the Fed Fund futures. Okay, this is basically what the markets are pricing in and expecting the Fed to do at their future meeting dates. Take a look at this column right here, right? This is all the future. This didn't happen yet, okay? Now you need to know where we are on this scale, and I drew up a little thing here to let you guys know what's going on. We are at this level, 425 to 450. That's where we are, okay? I don't see any hikes on the table. That's the first thing I see. It's only stuff to the left, John.
Yes, and I think to me, there's more stuff on the left. So I know we like to look at the blue boxes to kind of get that sense, but there's more. Like
there's more.
It's not conclusive, but it just suggests that that directional bias is now sort of shifting back to the lowering side.
Well, yeah, let's go over this. Okay, guys, we are here, and the next meeting is June 18th. The meeting after that is July 30th. 95% chance of a pause in June, 75% chance of a pause in July. First rate cut this year is slated to be in September, and that's a 55.9% chance. This keeps changing, guys. It's not
it keeps getting pushed back is what happens, right?
And it's not a terribly high number. I mean, right around that 50% mark, I get, a little hesitant and wary, and I just don't like to look at it. Once it's below 50%, I'm just very skeptical of it. It's just above that, still 29% chance of no cut, right? And that's, I feel like the markets are just, they took back a couple of cuts already. It was 4 cuts a month ago, or 2 months ago, whatever it was. Now it's 2 cuts, okay? September's cut number 1, October's a pause, okay? And then December's cut number 2. That's all you need to know, okay? And that's what I like to do on this show, is just tell you what you guys need to know in case you find yourself in a conversation with a Wall Street guy, and we want to stay in our lane because they're using us because we're experts on our market, not because we're Wall Street guys. And just let them know, according to the Fed Fund futures, this is what you say, according to the Fed Fund futures, the markets are pricing in 2 cuts this year, 1 in September, 1 in December. But the confidence level of those cuts is not the highest. It's a 39% chance of that December and 55% chance of September. Okay, yeah, 2 cuts.
And what is that cut percentage? Was that a 1/4 point cut?
1/4 point each. It's nothing.
Yeah, very minor. And the other thing is, look, that first cut is September, so you have to go through June. You got to go through July. You got to go through August, and you got to work your way in those couple weeks in September. That's a lot of room for headline risk, macroeconomic risk, like all kinds of stuff could happen in the meantime.
I feel like the risk is like in currencies and fiscal government debts. Like I think that's where the problem's going to be. I mean, that's the bond market vigilantes are. How are they going to handle this trillions and trillions of refinancing the U.S. has to do in a couple months? It's a lot. Like can't even comprehend the amount of money that is. Will the Fed have to print that money? I don't know. So we got a couple 60 days or so of the bond market going to be reacting to deficits and refinancing. So this could change. In my opinion, most likely less cuts. I don't know. I don't think it's gonna be more cuts, John. What do you think?
I'm continually surprised we don't see anything on the right hand side of this ledger. I get the sense that where we are, you could obviously have an argument for a rate hike. I'm surprised it's not there. I mean, obviously, that's not something I want to see, but
John's talking about here. Yeah,
right.
There's nothing in this area here. Right there.
Which
Take a
is
little smiley
surprising
face. Yeah, that's Johnny charts right there.
There you go.
Okay.
I don't want that. I like more cuts. I'd like to get Fed funds lower. I'd like to see, the 10-year go from 4.5 now. I'd like to have some pressure on that. I'd like to see it below 4. I don't think we'll necessarily quite get there. I just think that there's so much of this uncertainty baked into the market right now that you want to keep things a little bit elevated, just as a little protection.
Yeah. Meanwhile, guys, the macro headlines that you need to know about with the recent data that has come out is that the consumers pausing just a little bit, but the main thing is inflation is soft. Inflation is remaining soft, April. Take a look at the bottom right chart, guys. The bottom right chart. Change in core PCE price index. We're getting closer and closer to that 2% target. Okay. That's the key thing that the Fed likes to look at. They're looking at a whole bunch of things. But keep in mind, the Fed is going to be reactive, guys. The Fed is going to be reactive, meaning they got to wait for something to happen for the data to show it before they go and validate a decision. So they're not front running anything. They're not like doing a preemptive this, that. They're not going to do anything before. They're going to wait till after to do something. So
yeah,
interesting.
Well, I think when you look at that bottom right chart and you kind of see that gentle trend lower, I mean, that is the reasoning that the bond market's making for the rate cut, right? That's the reason why things are starting to shift lower. But again, if you just start thinking about the risks and the headlines, to me, like, I can understand how this could easily change on a dime. So again, I remain a skeptic. Hope for the best, plan for the worst.
Well, rates. Here's rates, guys. This is 30-year jumbos, 30-year conformings. Okay, the lighter blue is the jumbos. Okay, with rates, I mean, rates have generally moved to a higher place, right? I mean, I'm going to use my little camp out thing again. If you take a look at since like late April, there's been a bump up in rates, and for most of May, we've been just hanging around this higher level, right? Going up and down this channel where it's like right 6.8% to just above 7% kind of thing. And we're just in this range going up and down. I don't know. There's talk that the 10-year is going to flirt with 5%. I don't know. I don't know if we're out of this higher interest rate element just yet. Again, with this whole fiscal rebalancing and fiscal refinancing and all that kind of stuff that has to happen in the next couple months. There might be some rate volatility that's coming. Got to keep an eye on it. Okay.
There's a quick question. Someone asked PCE ? And I guess so PCE stands for personal consumption expenditures. That is the Fed's preferred measure of inflation. That's the one they tend to focus on the most. So that's why we're taking a look at it here.
And they look at a lot of stuff, guys. I mean, that's whether or not they changed inside the Fed and they're looking more at something else. I mean, we're not privy to that, but the core PCE is one of those measures that the Fed likes to look at, right? Elevated mortgage rates, guys. We're still in this mortgage rate element here. I don't know how much that's affecting Manhattan real estate, to be honest with you. If anything, it's making people rent. It's Noam Newman's thesis.
Well, that's the thing. But I mean, look, so it's really that light blue line is the one that's most concerning to us because that's the jumbo rate. And you look at how volatile and spiky that is compared to the 30-year conforming. So it's really all over the place. It goes down, it goes up, much more volatile than the 30-year. However, what I would like to say, one of the things that I tend to look at is the spread between the two. And when you have the jumbo kind of coming down on top of the 30-year and they're not quite widening, to me, that suggests mortgage rates could tick lower. So I like the fact that the jumbo recently in the last couple of weeks or so has sort of come back down closer to the 30-year. So I'm hoping we get a little bit of relief from that. Again, like looking on the horizon, to me, I don't see mortgage rates making a big move lower anytime soon, but touch wood, that could happen.
Well, again, Manhattan's like 60 60% plus cash. And you know what? It's interesting. The stock market has rallied. The whole April mess in the stock market has recovered itself pretty much. But Manhattan, I don't feel like is back at its earlier thing. Manhattan didn't recover. We kind of just are staying at this lower level. And I wonder if it could be because of the shift up in rates over the last month. I mean, it's moved up since late April up to here. So the stock market went up, the rates went up, and maybe that's just kind of
well. So one of the things we've been talking about is maybe we're just having this paused spring season. So we talked about the analogy to 2023, where we saw a spike in March, in terms of contract activity, faded in April, then came back in May. We were hoping to maybe see that, given the fact that April was bonkers this year. Didn't quite see it. Saw a little bit of a recovery, but didn't really do much. However, we still have summer. I mean, summer's still around as a season. It's usually quieter. But if you think about the fact that we're starting to see increases in supply, and you think about the fact that a lot of those sellers are also buyers, maybe this sets us up for a busier summer. I don't quite know. I think obviously we'll have to see, but that's the hope that I have.
Well, there's a chart floating around. Let's shift to national housing just for a few slides here. There's a chart floating around talking about how we do this often on the show. We talk about how the national housing market is doing very different things than the Manhattan market, but how there's more sellers than buyers right now. Which is interesting. You would have, with inventory so low, and you would have thought that it would be the other way around. But according to Redfin, there's about 500,000 more U.S. home sellers than U.S. home buyers out there, and that discrepancy is widening. And again, it doesn't seem to fit, the picture. And then you realize, well, wait a second, this housing market across the nation is really fragmented. It's what's going on in the Northeast region, right, is very, very different than what's going on in other parts of the country. And that's, in other parts of the country, the housing market's going through a downturn right now.
Yeah.
Well into it.
Well, and I think that's why you've seen that sellers line, right? That's basically units for sale. Inventory is obviously going to increase when demand goes sideways, because you're naturally going to have people adding their homes to the market, but they're not being absorbed. So that inventory gap is going to continue to grow. I mean, we got a couple comments, people writing in that the summer actually might be busy as people realizing that rates are not going to move. And also seasonality, is it a thing of the past? It's kind of come back. That's true. But, it really is by your own personal motivation is what moves you more than a season. And then, of course, our good friend Brian Morgan writes in, the market's lagging. Definitely a pickup since the tariff pause over the last 3 to 4 weeks. Yeah,
it is. The sales market is lagging. Everyone's renting. Guys, everyone's renting. Higher rates, right? Uncertainty. I'll rent. And wait it out. Noam Newman's thesis completely happening. So far, it's in the early stages, but it's actually like the psychology is there. We'll get to that in a little bit. It's interesting. The whole thing is so interesting. Sticking on national really quick, guys. I wanted to show you guys. This is what I was talking about. This is what's going on nationally. They're still kind of growing, but it's going down. Now I see this. This is major indexes: Freddie Mac House Index, Zillow Home Value Index, Case-Shiller, right? I don't know what Quotality is, but they're all kind of following the same trend, right? Down. It's not like the house prices are falling. But then I get this chart from Bravos Research that median home prices are in fact contracting. So it's like I'm getting disparate data from different sources, but I believe a big chunk of the national housing market is starting to see negative price growth in their houses.
Yeah, well, the tough thing about a chart like this is you think about some of the Sunbelt markets. You think about Austin, Dallas, Florida, Arizona. And they had massive price gains post-pandemic. So obviously, when you have huge price gains and you start to normalize, you might get some year-over-year sort of contractions that seem a lot steeper simply because you're coming from a higher place. But again, so this is a good chart. This is about home affordability, and New York, unfortunately, is in the red column there.
New York, but that's New York State. And again, you think of Manhattan, you think of New York City. We haven't had any price growth in 10 years.
But I don't think we're more affordable than New York State. I mean,
right.
All things being equal.
Yeah. And I thought this chart was interesting for you guys to see which areas are least affordable, which areas are most affordable. You're right, because Florida's up, 150% in the last decade? So the chances that they're going to fall down a little bit is very, very likely. Whereas we're flat. We're suppressed. But Anyway, take a look at this, guys. I just throw it out there. Some national housing stuff, so you have a general idea. Take a snapshot of this. Sometimes you have these kind of questions, right? I told you guys that we're going to circle back to Manhattan real estate, and we are. Okay, guys, let's just end on Manhattan real estate, and let's get the focus back on our hometown right here. I'm in the chart room, brand new charts. Let's go to the listing climate index. You guys know I love that chart so much. And take a look. I mean, when the new chart launches up here for June, look at that. Look at it. Look at March. Like, we knew it was happening, right? We knew it was happening, but we didn't get the print yet. Look at April and look at May. So if you guys have sellers, and this chart was designed to tell us the temperature of the listing environment. If you guys have sellers and you can't figure out, why am I not getting action on this property? We're priced very close to where we should be, or at where we should be, or under. You have to ask yourself, is it the market, right? Is the market changing? And the answer is yes. And now we're getting prints on it. This is like the hard part of our job. We got real-time data coming in. We knew it was shifting. We knew it was going down. This is a monthly print. I just got it June 1st yesterday. But it answers the question. Different place. Everyone's renting, John.
Everyone's renting, and I think this is a great time for me to do a shameless plug of our new service, UrbanDigs Advisor, in which we basically do a deep dive into the data for your specific listing. So if you got a seller that's, I mean, honestly, who doesn't have a stubborn seller? Or you have a buyer that's, quite unsure. Like, the UrbanDigs Advisor is a great way to sort of, show them the data that directly points at theirs. Got an appraiser slide in there. It's a really wonderful sort of product that we've got. So feel free to reach out to us on that. But to me, Noah, the question really about is that climate index falling. To me, it's almost a lagging indicator. And I think back to what Brian says, that the market's picked up in the last 3 or 4 weeks. But that climate indicator, it's really not going to show it until, look, I think the July one actually might be up, right? So, or the June bar, I guess, once we get into July, we actually might see a tick up because we've fallen quite a bit. So that temperature of the market, that climate gauge is really, it's kind of tough, because I think we're in two transitions. We're in a seasonal transition, and we're also in the sort of macro environment transition, right? We have the tariffs are behind us, summer's ahead of us, and so we're in this weird sort of limbo state right now.
So you're suggesting that the last few weeks, this is Brian, the last few weeks, I'm seeing a little pickup in activity. I'm not going to deny that, even though the data shows that it's weak, if anything. But you guys are a few weeks ahead of me. So if you guys are seeing a couple of weeks of activity of like bid action, negotiations, accepted offers, due diligence, I'm not going to get that for 2 weeks. So like, it's possible that it's happening. I'm not seeing it. But you're basically saying is that we're going to see a pop, a bit of a surprising upside.
I wouldn't be surprised.
For the summer months.
I wouldn't be surprised. I mean, June usually is a quieter month, right? The first couple of weeks busy, and then the second couple, once school's out, once people are like, it's warmed up, like you can actually go to the beach without a down jacket. Yeah. I think usually the market slows down, but I think we actually might have an extended season. This is what I'm hoping. This is my secret hope.
Well, there's an old saying: you can hope in one hand and crap in the other, and see which gets filled first. There, Johnny. Or is that wish?
Okay. Yeah, I don't know. Either way, I get the sense that we could have a busier summer than normal. Of course, I thought we were gonna have a busier spring. Back in the fall, I thought the spring was going to be busy. It was, and then we had our own goal a bit. So that sort of faded. I still held hope that this market is primed for a burst of contract activity, and I don't know when it's going to come, but it seems like it's always backstage, never quite ready for prime time.
Well, it's possible this is a bit of an overreaction and we bounce a little bit up here, but even if we go up a little bit up, I mean, you're not going to feel very, very different with the market. You'd have to see this bump above the green line to really, really feel it. So this is just, again, confirming, guys, that this market has shifted to a different place from wherever we were 60 days ago, and it is a weaker place, and leverage and sentiment has shifted away from sellers towards the buy side. Where we are in the whole scheme of things, it's not a buyer's market, it's not a seller's market. We're somewhere in that neutral zone, but it's just shifted away from sellers, and this is showing us that. You could show something to your client. Now, this is all happening when almost record sales prices are coming in. And by the way, this resale condo price per square foot chart is showing you the flat decade that we had. We have not moved anywhere in a decade. But these prints are pretty strong. And this is happening while the market's shifting lower. So this is a tricky period. If you guys have comps in the building, or good comps that you're looking at that are just closed, right? Or closed a month ago, it might reflect the period of time that was stronger than today. You know what I'm saying? That's different than when we are today. That's what happens when you have like a run up to March and into early April and then shift. We got to wait. We got to wait 3 months for that shift to reveal itself in terms of price discovery. That's August. Late July, August, September. That's when we're going to find out how much we really actually fell during this little down cycle. In the meantime, prices are coming in strong. And where's my rental chart? And here's rental rates, guys. Here's rental rates. That was 4,800. That was April. May eased up a little bit. It got a little ahead of itself. That's 4,700. That's 4,800. That's 4,700. But still, those 2 months are above the high water mark that we haven't been able to breach, that 4,500. They're both above it. So
right,
it's here.
And more importantly, you know, once that average starts working its way higher, it becomes difficult to stop. So I think 4,500 was a ceiling for a long time. It's now a floor. So we had 48, eased back to 4,700. Again, this is all RLS based. So it's going to be different than we see on Street Easy. It's going to be different than we see on RentHop or any of these different places. We're just looking at RLS listings. It's higher. And it seems the direction of travel is going to be up and to the right more than, you know,
yes,
down to the right.
I bets on when we reach 5,000. Like, I wouldn't be surprised if by end of summer we reach 5,000. I mean, I'm not predicting it. It would not shock me in the slightest to see this pop up based on some of the things that I'm hearing.
Well, so that's the question. Is that going to push people to the sales market? That's literally the age-old
thesis. That's Noam's thesis. I mean, anyone, guys, I where is it? Hold on here. Let me go back to the dashboard here. Sorry, guys. I know it's on Market Intelligence. Okay, it's got to be here somewhere. Where is it? A critical moment for New York City real estate, right here. That's where you could find this. It's free. You only need to be an UrbanDigs subscriber. It's 50 minutes. Listen to his thesis. His thesis is that now is the time for rents. And for the next 12 to 24 months. It's not just a quarter or 2 quarters. It's a year or two. So imagine this goes up to 5,500 in a year or two, or 5,700. Then there's going to be a period of frustration that's going to start a cycle shift from that period of time to the sales market. But that's a year or two away.
Right. A lot of comments here. This is great. So first of all, Brian Morgan writes in again, basically saying that you're exactly right. This market in the transition. Actually, looking at the data, it's actually too slow. The market's just moving very, very fast right now. I think that's an excellent point. Karen writes in, I got a couple of good comps in the same line. Buyers are actually coming in lower than the comp.
There it is. This is what I'm hearing.
Exactly.
I'm hearing these things now, and I don't know how to tell it to you guys like in any meaningful way that you could use in your practice. But this is the kind of thing that's happening. You're getting sales that are coming in from a stronger period of time, and you know the market's a little lower, and sellers don't know this stuff, and you have to kind of show them and validate it. So like this is, you know, we're very leading edge on this. This is an intelligence show, and we like to show you a lot of information, a lot of leading information, so that in a month or two when it actually comes out in prints, you're prepared and you know it. But yeah, the shift is real. We just don't know how much yet.
Right. We got Joe writing in, says the Westchester market has many pending deals. That's also very interesting because, I mean, it's not just Manhattan. It's not just New York City. It's the commuter areas too. You're seeing like, you know, Long Island areas, Westchester, Eastern Edge of New Jersey. Those are all those markets are doing pretty well
Northeast,
compared to, some of the commuter markets in the South, which are not doing as well.
Interesting, crazy times. And again, you know, I don't think the housing market is where the bubble is going to be. Certainly not in Manhattan, New York City. If there is some type of recession, housing will get dragged into it. But I think other housing markets are going to see a lot more severe of a correction than we are going to see during the cycle. Yeah.
Well, if you stayed on this long, thank you very much. I'm going to end this by putting Noah on the spot because we got a great little comment, and someone says, Richard writes in, I believe that the price per square foot is climbing because of more transactions over 4 million. So it's weighting the price per square foot higher. So Noah, here's the challenge. If we look at the UrbanDigs market index, which basically it's a hedonic index. So it's basically looking at the change by the unit type itself, not necessarily the price action. What does that look like? I don't know when the last time that updated was. Check it out.
Well, you're putting me on the spot. I gotta first off
putting him on the spot.
I have to. Do you have the link, John, for that?
I don't have the link.
Is it this one? Hold on a second. It's one of these.
This is not going the way I hope.
No, well, I don't have the link. You know what I'm saying? Like, what's up? Let me see if this will work. Hold on. One last try. Now, I don't have it. I'll have it for next week. I'll tell you this.
There we go. Okay.
I'll tell you, very similar to resale condo price per square foot, because that's a big component of that. It's very similar to this, and it's also showing us near highs. And I agree with that thesis. I agree. I think over the last couple of years, post-pandemic, the buyer of the Manhattan property has really leaned towards more renovated, better quality, bigger, more luxurious. And if you just take into account that whole thing, the market is not rewarding estate condition, low floor properties. They're penalizing those properties. They're rewarding the other end of the spectrum, the best of the best, best, right? And I think as a result, that's been kind of holding this up. Like in reality, we could have even been lower. So I think that's what's going on to some degree. Yep. Very good point. Sorry, I don't have the UrbanDigs index, but it's very.
Well, I sent you the link if you want to pull it
up.
Where?
Where'd you send it to me? Slack.
It's in Slack. So, okay. But it's interesting because we have the March number and it's just much higher. You can clearly see that there's a
there you go,
an uptick. Yeah.
There you go. Very similar. But look at that. Look, I'm telling you, and that's gonna go. See, like if you think about that for a second, that's March. So that's March contract signs. So I'm not so sure if April, that might actually be it. Because that's, if you go to resale condo price per square foot, these are closings. Right? This is contract signs in March.
Right.
So it might peak out about there because April's probably going to be a little lower, I would think.
Yeah, I wouldn't be surprised to see us tick down, but then start moving higher. But it seems like it's starting to pick a direction here. Last question: is Brooklyn sales data mirroring Manhattan's?
For what? For resale condo price per square foot? I mean,
yeah, we could. The thing with Brooklyn
sales really the townhouse market.
It's
there you go.
Such a split between. Yeah,
well, look at that. Look at that. And now if you go to townhouses, I mean, I don't know if you want price per square foot for townhouses, but it's going to probably be much more of an upward slope.
Yeah.
There you go.
Oh, they clarified. Yes, resale condo price per square foot.
Yep. There you go.
Yeah.
It's all in the chart room, guys. Play around. If you guys need a new trial, okay, just register for a free trial, 2 weeks, get it free, no credit card. If you had a trial and you need another 7 days, email me, Noah@UrbanDigs.com. I'm happy to give you a 7-day trial and you guys can go do all the charts you want. But outside of that, I don't want to take up your time and hijack your day, guys. Is there any more questions, John?
No, all good.
Okay. Well, thank you, guys. Thank you, John Walkup. Tomorrow, guys, hopefully you can join us. We'll talk about price reduction strategies. There's a method to the madness. We have a couple of ideas that might help you get a price reduction. Join us for that. Otherwise, this has been a nice Micro Monday session. Interesting times, guys. We hope to catch you next time. Cheers, everybody, and good luck out there.